So should we get started?
Let's get started.
All
And
right.
let's do this. Let's spend 15, 20 minutes at most.
All right.
We can
Yeah, I
banter.
actually, and I'm recording right now, so I can
Yeah.
just share something with you. And I wanted to tell this to Kelly. Kelly, there's a guy that goes to the gym with me. His name's John. He's a really high profile realtor in the city. And he was asking me what I've been up to. And I was telling him about you guys. And I was like, yeah, I'm kind of helping with dental transitions, practice valuations, and things like that. He's like, oh, man, I wish I knew about you. I have a building. I sold the dental practice, but I've got all this equipment and I've got all this dental equipment that I'm trying to sell. And he's like, I'm glad you talked to me. So I was like, yeah, me too, because I don't know if we can do anything with that, but he seems like he definitely wants to try to sell it. And I know I've seen on those websites, some of those websites that you've shown me that also have like practice listings for sale and associates, positions for associates. They also have, I thought I saw like equipment on there too. He has a bunch of dental equipment. I don't know what kind of condition it's in or anything like that, but he wants to grab lunch next week. So I was thinking about inviting you to join us so that you could maybe sit in and help me know
Yeah.
what the heck's going on. He's super popular on social media and he's very successful. I think he's like the president of GAR or something.
Hmm.
So
Yeah, absolutely.
John Lopez, his name is. But anyways,
I
all
think I
right.
know who you're talking about.
Yeah, he's got billboards and everything.
Yep. Yes,
So
billboards.
yeah,
I
he's a
actually think I saw
power hitter.
one of his billboards down in the near downtown where all the tent city is.
Yep, sounds about right.
Yeah, so I was like, wow, he has this big old billboard over here.
And he's
Cool.
on
But yeah,
billboards
I think
and
I know exactly who you're talking about.
yeah, and he's on bus stop seats, right? Or the
Yes.
bus stops.
Yeah,
Big
You may have
advertiser.
sat on his face.
you may have sat on his face.
We need to edit
There's
that
an
out.
intro right there.
Welcome to Getting Down to Business, the go-to podcast for dentists and business owners looking to master the art of running a successful practice. Each episode is packed with invaluable insights and practical advice tailored specifically for the dental industry. Now, let's meet our expert panel. First up, we have Eric Bergmeyer, a certified public accountant and certified valuation analyst. Eric brings a wealth of knowledge in financial management and business valuation. Joining him is Cheryl Bergmeyer, also a certified public accountant, known for her expertise in financial planning and strategic business advice. Next, we have Rachel Robles, our valuation specialist. Rachel's insight into business valuations are invaluable for understanding the true worth of your practice. Kelly Yardman, our business broker consultant, brings her extensive experience in buying and selling dental practices, offering unique perspectives on the market. And finally, Josh Wagner, our sales and marketing specialist. Josh's strategies will help you grow your patient base and enhance your practice's reputation. Together, this team will guide you through the complexities of balance sheets, income and cash flow statements, valuations, and much more. So, whether you're starting a new practice, looking to expand, or just aiming to fine-tune your business strategies, you're in the right place. Now, let's roll up our sleeves and let's get down to business.
Today we're going to be looking at a very specific set of financial statements, one in particular. That would be the income statement. We've actually been talking for the last few weeks about the different types of statements as we've gone through January. So we're just going to be diving into the income statement in particular. So, Eric, I have a question for you about the income statement. Why is it important? And can you just, in the simplest terms, summarize what it is? Is it for a specific period of time? Um, what does it show? Just go ahead and take the
Sure.
wheel and tell us
All
what we need
right.
to know about the income statement.
Okay, perfect. So just to remind the audience, we started with what are the three basic core financial statements you need to be looking at. We've got a balance sheet, we've got a statement of cash flow, and we've got an income statement. And last week we did a deep dive into the balance sheet. Today we're going to do a deeper dive into the income statement. And as we talked about on the previous episode, the income statement tells us really, from the very basics, and where I'd like some input from everybody else here, just because I get a little bit more technical on this, but really from the simplest of terms, what cash comes into the practice, and then cash that goes out of the practice via our expenses, our normal operating expenses, leaves us with a number at the bottom, hopefully a net income rather than a loss. And generally that income statement is prepared on a monthly basis. And then we also look at it on a year-to-date basis as well. So it tells us over a period of time how much income came into the practice, how much cash came into the practice, and then what are the normal operating expenses we see out of a dental practice to give us, at the end of the day, an operating income number. And that's, in the simplest terms, what an income statement is. And I'll welcome the group here if anybody wants to share anything. I think, Rachel, from your perspective, what do you see when you think of an income statement? Because you're probably more a non-technical person coming in looking at income statements compared to Cheryl and I as CPAs.
Well, first of all, it's very important to me to see a net income being a positive number, not a negative number. But also, I try to reserve all my judgment until I've had an opportunity to understand exactly what is operating expenses versus non-operating expenses, because that can have pretty big adjustments. But overall, to me, the income statement is going to show me the health of the practice.
Yeah, and you bring up a very good term that I wanted to make sure we get into a little bit more detail on: operating versus non-operating. And Josh, if you can we go ahead and share your screen right now? And let's go ahead and pull up the income statement we were just looking at. Yeah.
Yep.
And this looks pretty good to me here. And so when Rachel's talking about operating versus non-operating, and I know we've got a lot of detail on here, but quite honestly, this is kind of a summarized income statement, other than it provides quite a bit of information for this particular practice. And what we're looking at for this practice is 9 months worth of data from January of 2023 through September of 2023. And that's the first two columns. The second two columns would be the comparative to the year earlier. And then the last two columns are the dollar variance and percent variance. And I want to touch real quickly on what Rachel discussed on the operating versus non-operating. So in any business, as we briefly touched on in our introductory meeting, there's normal operations, and then there's non-operating activities. The normal operations are the things that you normally think of when you have a dental practice. I provide a service, and there's service income. I pay my people, and there's normal salary expense. I pay rent, and there's rent expense. I pay supplies, and there's supply expense. But then there's also non-operating, and when we prepare an income statement, we show the non-operating towards the very bottom of the income statement. So Josh, if you can kind of bring your arrow all the way down to, let's say, stop right there at the operating income. This is at this $436,000. This would be the normal business operating activity generates an operating income, in this particular case, of $436,000. Towards the very bottom, as Rachel pointed out, there's two other items that are going to come into play that we tend to see in a dental practice. There's depreciation, and that's an accounting term that we can discuss in a little bit more detail. Generally considered a non-operating activity. And then there's interest income and or interest expense, which would also be non-operating items. So this is a little bit more of a more complex set of financial statements for a dental practice, but this is our preferred methodology of how we want to show the operations, the financial operations performance of a dental practice.
Yeah, Eric, I don't know if I would call it more complicated, but it's more targeted to highlight specific information that we look at. So,
You're right. You're right.
yeah, so I wouldn't say it's not a complicated thing, but if you were just running your financials out of QuickBooks, let's just say that's what you're doing, this is not what you would get out of QuickBooks. By doing it this way,
It's more robust. It's more robust.
well, it's more, it's categorization by particular groupings that tell us the story.
Yeah,
Right?
when you talked about like QuickBooks, when you get financials from a new client, or Rachel, sometimes when you see financials and they come to us out of QuickBooks, like what do you see when in regards to that? Because they're just line item expenses in alphabetical order.
Correct. It does not, normal straight P&L is not going to separate operating from non-operating expenses. It'll have income, all expenses, and then you may have a section that says other income. You may.
Yeah.
But that's pretty much it. It doesn't tell you what is required to run your business versus things that are not necessarily required to run your business, operating versus non-operating.
I have a question for you, Eric.
Yeah.
I might be jumping ahead here, but if I was a doctor, I was a dentist, and I was thinking about giving my staff a raise, would I be looking at this statement, or would I be looking at one of the others we talked about?
That's a great question, and I love you asking that question, because that is common. You know, sometimes the doc doesn't know whether he or she may be looking at the balance sheet and saying, "Where's my payroll expenses?" And clearly, the answer to your question is this is the right document. You want to be looking at your income statement, and when you, Josh, if you want to go maybe to the upper third of this, when you see total salaries, payroll taxes, and benefits, just a little bit further down, just bring me down a couple more lines and you're going to get the grand total of all of those. And you can see through the 9-month period, this particular practice paid out $214,000 of salary related, employee related benefits. And then to your question, do I know if that's a good number or a bad number? And do I have the opportunity to afford a raise without breaking the bank of this particular practice? And this is where we want to move over to the next column with those percentages. And in this particular case, 214,000 represents 24.3% of the collections that have come in. So this is where that common size column is important, and what you don't typically get out of just a dump of financial statements out of QuickBooks. You just don't get that level of detail immediately. But
So, Eric,
now that we know.
But in this case, so we see that 24%, is that a good percentage?
Yeah, and so when we look at that, we say, well, 24% is really an extraordinary percentage on this particular revenue that's coming in. Generally, from the standards that we look at it for a general dental practice, that number is typically around 30%. And what we've been seeing over the last couple of years, the numbers tending to creep up to 31, 32%, just because the rate of inflation on payroll has been so challenging to docs. And so whether or not this is fictitious or real, this particular practice is benefiting tremendously from a great revenue stream compared to its employment expenses. And so then in this particular case, Josh, to your question, there is definitely opportunity to provide raises and stay well within the industry standards. Obviously, whatever raise is provided will have an impact on the net income, but this is a particular practice that can afford to easily do so and still stay within the normal trends of a general dental practice.
I see that in this income statement, it doesn't, in the under salaries, it doesn't have, even though it does say benefits, it doesn't say, they don't have benefits, but that would also be a component of this grouping that to take into consideration.
Yeah, this
as
particular client
for your salary.
This particular client probably doesn't have health insurance coverage for
Right.
their employees, nor does it have a retirement plan.
And that could
Correct,
very
right.
well be the reason why these expenses are below the norm. But to both
Right.
statements you've made, if this particular practice had those expenses, they would be associated up on this line, Kelly. You're absolutely right. This would be where those benefits would be. All those employee-related costs would be under that particular category.
So I'm looking at the total income, and I mean it's almost $1 million. It's almost 900K. And I'm looking at down way at the bottom, it shows the net income is only 120K. So is that typical? It just seems like that's a really big jump from
I don't think
800 to 120. It's a lot
I
of
think it would
expenses.
be more important to look at the operating net income line instead of the very bottom net income line, because we like to see the operating net income not more than like 60%. So, or the
The
net
expenses.
operating expenses not more than 60%. So what's in non-operating expenses? That's discretionary. That's up to the dentist. So what is more telling of the practice health is going to be that net operating income line and what's included in operating expenses.
That's absolutely correct. And so when we had this conversation with the client who had just purchased a practice, and we were able to sit down with her yesterday and go over financial statements with her, the way I described this was, to Rachel's point, if you collect $100, $50 goes to cover, and this is the example for this particular set of financials right here. $50.50 go to cover your operating expenses, and then $49.50 are left for you. And when we look at that relationship, when we look at that margin, to Rachel's point, a healthy practice is typically a 60-40 type relationship. In other words, on the $100 that comes in, $60 goes to cover true operating expenses. $40 is left to provide the doctor a salary, and then there's going to be something left to cover, if this is a new practice and it was acquired with debt, an amount to cover debt service. And so in this particular case, Josh, as you observe, we go from 882,000 in collections up top to the very bottom of 120,000. What you skip over and partly through here is the compensation to the doctor.
So are you saying that, so the owner of this practice is also the doctor, right? He's getting out of this 800, sorry to interrupt, out of this 800K. Before we get down here, he paid himself this amount and his wife and the taxes and stuff, right?
That's correct.
Okay. That's
correct.
Sure. Okay.
Yeah.
So this net income is like leftovers.
And the net income is what's left.
Profit.
Yeah. But really, to Rachel's point, the operating income is what's really the net income of the organization before compensation to the owner and these other expenses. I mean, depreciation, and sometimes if you have debt, you're going to have interest expense. But really, if you're looking at the operations of the company outside of paying the doc and again those other income and expense items, the company made the doctor $436,000. That's what this tells me.
Yeah.
Like if I'm saying, okay, gosh, I'm working so hard, like it seems like, God, 120 doesn't seem like the right number. It seems like I should be making more than that. The doc's making 436.
Gotcha.
With less than 15, but for the other expenses. But we started doing these financial statements this way a few years back, because it really just the general financial statements you get out of your standard QuickBooks, Xero, but other software doesn't tell you the story this way. about what does the doctor, the owner, really benefit from this company. And so itemizing it out this way tells them a better story. And it's not just sugarcoating it. It's just saying, here's really what it looks like.
One of the other things too is like that top, on the top line, the income where it has less gross receipts tax collected. Sometimes, and I've seen this in other financial statements from other firms, they don't have that. They have total collections, and that includes the gross receipts tax. So sometimes when businesses make decisions, they base it based on the total
Like a
patient
gross number.
collection. Yes. And that's a very grave mistake. And why would that be, Eric?
Yeah, well, and that's a really good point. When you look at a normal output from QuickBooks, gross receipts tax may be buried. Will be buried. And again, the gross receipts tax, if we're lucky enough to have a nationwide audience, gross receipts tax is a odd tax in the state of New Mexico and the state of Hawaii, where services to some degree are taxed, like a sales tax. Now, when you collect that tax at the time a service is provided, that tax revenue is not your revenue. So if you're looking at those taxes as a below the line, Kelly, to your point, your revenue line looks artificially inflated by a number, and it's not an insignificant number. And if a doc's thinking, well, my practice is worth 60% of collections, and I have now inflated my quote unquote collections number by gross receipts tax, I may have now, in my mind, established a sale price or a value. And again, we're going to do a whole thing on the valuing of a dental practice that gets far more complex than just simply a percentage times revenue. But that's where you're going to get some of your analysis is going to be thrown off if you're working with an income number that is higher than what truly is your income.
Well, and all of these percentages would be skewed.
That's right. That's right.
And many times we see that gross receipts tax treated as an operating expense, which then makes your operating expenses look a little, so the net income, the net result, the bottom line won't change. It's just where it lands. And then how that goes into the calculations for these common sized percentages.
That's right.
And that's why we do it net of the gross, because really we do it net of the gross receipts tax because it's not our money. It's not the doc's money. So
and that's standard financial reporting. That's the way it should be done. Cheryl, to your point, your income is your income. Your income isn't something more, and then you're going to arbitrarily decide what you're going to give the state in terms of a sales tax. No, it's very clear. You're collecting that, and that income does not, those receipts do not belong to you. Yeah. So we want to show that, and we work with that net number after gross receipts.
Yeah. So when we talk about, when doctors do talk about collections here in New Mexico, we have to be careful because we have to take into consideration the reduction for the gross receipts tax. Now, not everything that you collect in your dental practice is subject to gross receipts tax, which is a whole other thing, especially
a webinar for another day.
Yes.
What was that you just said, Cheryl? I didn't hear all that.
So just because they collect $908,000 doesn't mean all of that is subject to gross receipts tax. It gets very complicated in New Mexico, especially unless you're all fee for service, and then that means everything is subject to that gross receipts tax. Anything, if you are contracted with insurances, there's special deductions and adjustments in the gross receipts tax calculation for those.
Yeah, far more than we want to get into.
So that's a separate episode.
It just opens a whole other can of worms because they changed the rules last July too.
And we're closing that can right now.
Is there anything else that you want to point out on this particular sheet?
Before we leave this, as we mentioned, when we as we started it with the introduction, we're going to build this webinar and this conversation that we're having, our fireside conversation on financials around, our good friend Norton Henley. He had written the book on getting down to business. One of the things that Norton routinely discussed in the book and where Rachel and I do spend a lot of our time on those two concepts of return to labor and return to capital. And so when Cheryl pointed out to the operating income of 436,000, that is the number we kind of begin with, from which the owner, in this case, has an amount of that 436 coming back to them as a return to labor. In other words, compensation for the work they do, generating that top line revenue. And that's where this gets a little arbitrary. What is that right return to labor? But whatever that number is, Josh, you kind of identified as like, gee whiz, there's 430. We start at the top line with 882, but we end with 120. But between that 882 and that 120, we have those operating expenses. We have a return to labor charge to compensate the doc for their services. And then that very bottom line, that 120,000, arguably is the return to capital. In other words, their return on investment. And when we do the valuations, and we'll get into that way more next month, that return to labor is an important number. That return to capital is a very important number, because at the very beginning of time for a dental practice owner, most of that return to capital is likely going to cover debt service. In this particular practice, we know that there's very little debt, so that $120,000 is typically going to the doctor's pocket at home as a draw out of the practice. But I wanted to make sure we started at least pointing that out, because when we do get further into the valuation work, and we do principally look at the income statements to help us do those valuations, we stand fast to those two very important terms: return to labor, which is the owner compensation, and then return to capital, which is the return on investment.
Return to labor being the owner compensation in the scenario where there's an owner operator. If the owner were not the dentist, return to labor would be what you pay the dentist that runs the practice, even if they're not an owner.
That's correct. That's correct.
So in this example, or for an example, then let's just say it was, if someone else was the owner operator, would that mean, they paid the salary to the doctor, the 190? Does the owner operator get the 120? Does he get the return to capital?
The owner would. That's correct. And in this particular example, if we wanted to go down that path, we would have to ask the question whether or not $190,000 is a reasonable compensation for a doctor who is not an owner but working in the practice. But yes, Josh, to answer your question simply, if I were to own this and I'm not a dentist and I paid out everything according to this, then arguably speaking, at the end of 9 months, I would have a profit of $120,000 for me. Now, if I had debt to buy the practice, that $120,000 may come down further by that debt. But if I paid cash for the practice, that $120,000 comes back to me.
That makes sense.
Which brings you back into like the cash flow statement, which
I just wanted to be clear the difference between return to labor being an owner operator and a non-owner dentist. It's either going to be above in operating expenses, right, or if you are an owner operator, then your income is discretionary and is then below the line. But if you're an owner and you're not a dentist, then you absolutely have to pay a dentist to run your practice. And now the compensation to a non-owner dentist is going to be above the line.
Yeah,
it's going to be
salaries up in that 14.
We call above the line, meaning above the non-operating expense line. So yes, the compensation to a non-owner dentist being required to run your practice is going to be in the operating expense line.
Mm-hmm.
That's a very good point.
Yeah, so the 214 up above would be more like 350.
That's right. Yeah, and I like the presentation this way because it gets to tell the story a little bit more with the doc, and he or she should ask, how am I doing this year? And I like the presentation this way because the last column tells us the story year over year. Business is up, right? We look at the top line year over year, collection income is up 13.6% or $105,000. That is a nice increase, and we can have lots of conversations about why that's happening. And as we scroll down, it's very interesting. In this particular example, almost, well, not almost, all of that falls to the profit line, the operating income line, the net margin before owner compensation. So this is very bizarre if this is an actual, and this is
Right, because you're essentially the story is, I've made an additional 105 grand in revenue with no additional expenses, which is
Yeah.
really impossible.
Which has been very
and quite frankly, there is an increase in those other, you can see there is an increase in cost of goods sold. There is an increase in salary and benefits line. However, there's a significant decrease in the administrative expenses.
Yeah, they dropped
that
advertising.
offsets it, and this may be the case where they may have been using a consultant for years, and those consulting expenses are now winding off the income statement because that engagement no longer has expired, but the doc is now benefiting from all they learned from that consultant, and now voila, I am making more money. I am now getting to keep more of that, and at the same time, I'm now no longer having to pay that consultant, so more of that money gets to come to my bottom line. That could be the story here. I don't remember the specifics of this particular client, but that's generally what's going to happen here. There may have been other reasons why those other expenses were much higher and now are significantly lower. But this is a nice story to share with the doc. Hey, you're doing more, and now as we go to the very bottom line, you're keeping more of that as well. So, so good for you. You've really improved the profitability of the practice. And you can see that throughout. And as we go back and we can, as we summarize with the cash flow statement next week, we can always go back and show, yeah, and all this means there was more cash in the bank for you from which you can do other things with.
Yeah.
But
well,
that's
the other thing,
my most favorite. Go ahead, Cheryl.
The other thing about the way this is presented, looking year over year, is from a tax planning perspective, you shouldn't go into the end of the year and you get a surprise, right? So here we're saying, okay, last year at this time you're at 45,000, we're at 120. We're in a different tax situation right now that we have to have conversations about.
That's right.
And so going into the last quarter of the year, you can start to make some decisions. Again, we can tell it does not look at this point that there is any retirement plan for this company. So maybe that's something to consider and talk about. But I think that's the other thing too, is to say, okay, yeah, you're doing great. Thumbs up, everyone's happy, but hey, don't forget, Uncle Sam will be calling and we'll want some of that increase that you have. So are there ways that we
want to take some of that happiness away?
Yeah, we give it and then we take it away. And then we crush you. No.
Yeah,
but we'll be strategic, okay?
Well, that's the thing.
We'll help you keep as much as possible.
Yeah, I mean, that's why we look at it and we say, okay, yay, this tells a great story. But then, yeah, from a tax perspective, it does something, something different. It tells us we're going to owe more. That's just how it works. But are there things that we could do in the last quarter of the year to mitigate it, to address it, to change the tax situation?
Yeah.
And Eric has his 10 top tax tips. I can't even say that.
Top 10 tax tips.
Yeah. Oh, these are beauty sites.
Fast.
When we started the introduction for this section on financial statements, we talked about internal users and external users. And as we were looking at the very bottom here, that net income, I think about maybe, I'm part of the internal team on this one. So we do talk about tax planning, and as we're sitting with the doc and we're not sitting for the first time in September, we're looking at these financials beginning really 6 months into the year. So as a internal user with the client, with the doc, as an advisor, Cheryl, to your point, we can start looking and saying, wow, we see a nice trend here. And we need to be thinking about a handful of things that we can do to either mitigate that tax liability, and
Or
if there
plan
isn't
for it.
much more we can do, we're going to be in a situation where you're making more money. There's only so much we can do to limit that tax liability. We need to be thinking about setting money aside to either prepay some of that tax burden or have that ready when we file. Should things change in the last quarter and we may not find ourselves in that same situation, but clearly a client that's performing this way is likely going to go in the fourth quarter still performing this way. So let's make sure we're adequately funding that tax liability either through wages or estimated tax payments. When we talk about Rachel and the valuation role, and we talk about internal versus external users, a lot of times Rachel and Kelly are looking at these financials as external users with the bank. And we're looking at these with a banker who's looking to potentially finance a potential sale. And so these financial statements become this particular set of financials, this income statement, is arguably the most mission critical statement a banker will use to underwrite an acquisition.
I'm going to
So-
disagree with you only on one point.
Okay.
This income statement does not take into consideration discretionary spending. So
Right.
an adjusted or normalized income statement
Right, and
is gonna,
yeah, the adjustments coming out, so if there was a lot of travel in here, that may be pulled down a little bit. The meals and entertainment may be pulled out a little bit, right?
it can,
sure.
it can change a situation.
Yeah.
Discretionary meaning expenses being too small or expenses being too big. It can go
Yeah.
either way.
And
And-
Rachel, when we get to the valuation section of this next month, we'll actually go through kind of the columns that you see and say, here's what you've reported, Doc, year over year over year. Here are the things that we're making adjustments for. Whatever they may be, whether they're up or down. And the purpose of today's conversation, I have to go into that deep dive on that side of it. But clearly, when we get into the valuation side of this, one of the chapters in Norton's book, we do want to pay a lot of attention to that particular process, of course.
Well, and I think just for the audience's benefit, Rachel, can you describe what it means for it to be a discretionary expense? Like what would you consider, like how do you determine what's discretionary?
Discretionary, a discretionary expense would be a non-operating expense, but it may show up before we adjust for it. It may show up under operating expenses, like it may be travel or auto-related expenses, or it could be discretionary salaries. Go ahead.
What about like consulting fees? Are they considered discretionary?
Yeah, it depends.
You're right.
Yes.
Actually, that's the perfect answer because a lot of these things do depend.
Everything depends. Everything depends, and we're going to have to look at it. The fact that there's a spouse's salary below the line in owner's compensation, which is a non-operating expense in this case,
Yeah.
I would say it depends. Because if I, in doing the due diligence and the valuation process, found out that spouse actually provides a role,
Service.
plays a role, then I think that's not discretionary. And I
That's a
actually
really
wanna
good
know
point.
what's the fair market value of that
Carol, you're
position.
non-discretionary.
So
So you're
discretionary,
non-discretionary in our firm.
land
Eric's
the plane.
telling us to land this plane.
We're gonna let
Yeah,
you.
this is.
But
this
I have
is,
to say, but Eric, the reason I asked about that, but Rachel brings up a really good point, is that sometimes when businesses who have spouses who are actually playing a very significant role as like an office manager, she's saying that's no longer a discretionary that should be below the line. That needs to be up and operating because the next doctor that owns that facility is going to have to hire someone and have salaries up in that line. So that's going to impact
Of course.
the profitability. So that's what you're saying.
Of course.
Again, gets into the valuation stuff. So.
As I mentioned, we're going to deep dive all that next month when we do valuation of a practice. I wanted to keep this just to the income statement in the simplest terms possible. Understanding how
But
complex.
Nice try.
there's a lot of content that we can educate people about, and so I'm excited to learn more. I know that I always learn something new when I get on these calls. So thank you all so much. We appreciate your time. Thanks for checking out Getting Down to Business. And next week we're going to be going further into the financial statements. I believe we're looking at the cash flow statement next.
Statement of cash flows next week.
Okay, great. Can you give us a little preview, just a quick preview of like what to expect, or any homework that we
Cash
might want
flow-
to
the cash
look
flow
at
statement
before
it tells
we're
you where your cash goes.
back here again?
The statement of cash flow is probably one of the most complex statements to understand, but it solves the question that I think Kelly likes to ask all the time. Gee whiz, Eric, it looks like I have all this net income, but where did my money go? And the cash flow statement helps explain that. You don't see that on the income statement. You don't see that on the balance sheet, but you use the balance sheet and the income statement to help navigate through the cash flow statement. And that answers the question generally, where did my money go? And so, yeah.
It's Eric's
that
favorite financial statement.
Perfect.
It is I enjoyed.
If he wasn't married to me, he would marry a cash flow statement.
All right, and on that note, we're going to wrap it up for this week. But we will see you next week on Getting Down to Business. Thank you so much for joining us.
Awesome.
Bye-bye.
Thank you for tuning in to Getting Down to Business. We hope you found today's episode enlightening and empowering as you navigate the world of dental business. Don't forget to join us next week for more insights and expert advice tailored to help you run a thriving practice. Until then, keep striving for excellence in your business. We're here to help you every step of the way. Thanks for listening, and remember, we'll be back next week to help you get down to business.
Than a year-to-date income statement to show not only how I did for the given 30-day period of the month, but where do I stand on a year-to-date basis. And really
I'm
what
so
we're
sorry.
trying to look at.
Guys, we got to stop. I was sharing my screen.
Okay.
I was just
Sure.
typing that to you. I'm like, you're sharing your screen
I'm
the whole
like, why
time.
can I not
We're
see
looking-
anybody?
Looking at the income
That's okay.
statement.
That was like a little dry run intro.
And Eric, why do you sound like somebody stuffed you in somebody's pocket?
I don't know. Why do I sound like that?
Oh,
Do
look
I
at there.
sound
My
like that
mic's
now?
much better now when I tilt the camera down.
Because he's always stuck in someone's pocket. Daryl?
But
I
what
guess
does that mean?
You all sound like that. Maybe it's
Do I
just
sound
like
any
my.
different? Do I
It
sound
must, I
different than
think it's
anybody
just
else?
my computer, maybe.
Oh, I think
Kelly,
you
do
sound.
I sound-
He always asks you that. That's why I said that.
Do I sound any different right now than I do any other time?
No,
Well,
Okay.
I
not
mean,
me.
Not really.
Then Cheryl, this is either how I sound or it's your jacked up computer.
It could be my jacked up computer.
All right.
All right.
Rachel, do I sound different to you than what I normally sound like?
no, I can hear you well. You sound normal to me.
Okay.
You sound
right.
muffled.
You're
Which
not
is
in my
normal.
pocket, so.
You sound like you normally do when I stuff you in the pocket.